Hey traders, a very warm welcome to you. So in this video I want to talk a little bit about key levels and scalping around a key level. Listen, we all know what key levels are. If you haven't, go and check out some of the previous videos. We talk about support, resistance, highs, lows. Any of those are kind of key levels. Now, what I mean when I talk about scalping around a key level, the traditional kind of trade setup or strategy, if you like, is to, when a trade comes up to your key level, you've got kind of two options. You're buying it for a fade and a bounce off, or you're selling a breakthrough, right? It's pretty kind of simple stuff. However, I think you can go one step further than that, and you can look at key levels in a completely different way. And it's something that I do a lot of. It's something that when the markets are very, very active, this is a good strategy to implement. So scalping around a key level. Often market's going to come up to a key level and they're going to trade around it multiple times before they finally break through. They're going to bounce off it, they're going to test through it, they're going to literally use it as a kind of pseudo pivot. So if that's your key level here, they're going to break through, they're going to oscillate around a little bit. It's acting like a magnet. Supply demand at each end of the scale. One side of the coin you get supply backing off a little bit, comes back to the key level, overshoots, you get the overshoot back and forth around a key level. So what's the point? What's the advantage of that with traders? Well, if we're scalping, this is literally only scalping, guys. Obviously, on a swing trading perspective, you may be able to extrapolate that out onto your kind of daily time frames and look at how prices are responding to those daily key levels. But I'm really looking at this more from a day trading perspective. As the market's coming up to prior highs, as it's coming to key levels, it's going to be doing a lot of business up and back and forth. And so as a trader, you can look to scalp these opportunities. You can either say, listen, as we go through the key level, I'm going to fade it with a strict stop loss. As we come up to the key level, I'm going to look for a continuation up to the key level, literally using, as I say, like a magnet force that is pulling the market to it, away from it, and assuming that there's a little bit of mean reversion, even if eventually you're going to break through. That's the kind of the crux of the trade, is to say, listen, I don't think we're going to break through the very first time we hit it, so I'm going to trade a fade as we come up to it. I'm going to fade it when I perceive there's a little bit of a slowdown in tape, when I perceive that we've kind of jumped through. And again, this is where it comes down to your own trader discretion. Look for a ping pong back through, maybe cover it there, wait to see what happens next. If it overshoots, maybe I'm going to go short for a little retest here, overshoots again, go long, expecting at some point to be stopped, and you're kind of looking for 1 for 1, maybe 2 for 1, 1.5 to 1 risk reward ratio, but thinking that I'm going to get a fair few bites of the cherry before it does ultimately stop me out. Let's have a look at something else, like let's pick a currency pair, AUD USD for example. It's been a bit of or in fact it doesn't really matter in terms of what situation. So let me get my drawing pen off, scrub that off, get it back onto the cursor. Bear with me, gentlemen and ladies. Okay, so let's look at an example here now. So we'll pick any kind of place here, and I've got a 3-minute chart of AUD USD. Key level down here, right? We've come down. I don't know what day this is, it doesn't matter. We're better to not be cherry picking stuff in, but this is still a decent example. There's our push lower, so we've got our low and kind of congestion from the prior day. So the next day we're looking and saying, okay, we've got our key level. Where are we? We've got our key level. Let me zoom in so we can see. We've got a key level early in the morning. Australian time is going to be perfectly normal. There's our key level here at around what is that? It's about 0.796 approximately. But you can see we've kind of made a pseudo pivot. So the next day we have several bites of the cherry. We say, okay, any kind of move away from it, we're looking to short towards that pivot level. Any move away from it to the downside, we're looking to buy coming back into the pivot level, just playing that rotation until eventually we're obviously going to get stopped out at some point. I'm not saying anything here that this is a foolproof method and you can do it continually, but what I am saying is that levels often will be traded around multiple times before you finally get that break. And if you're very good and very disciplined at controlling your risk and saying, listen, this is my risk, if I can get 4, 5, 6, even 10 bites of the cherry before it stops me out, I'm going to make a profit on this, and I'm very strict with it, and I'm very kind of good at cutting the trade when it's not working, you'll be surprised at how profitable it can be. So in other words, you're not looking to try and guess the direction of the market. You're not looking to say this is going to break out, this is going to fake out, this is going to fade. You're just saying, hey, this level's a big level. It's going to act as a magnet. We could oscillate around this for a long period of time before we eventually do some business to the high side or to the low side, and treating it purely as a kind of scalping methodology that is alerted to you when you hit the key level. So the alert goes off, you come to the key level and you say, right, how am I going to frame this? Am I going to use 10 pips, 15 pips, 20 pips? Okay, bracket that trade, bracket that key level and say, you know, selling above 10 pips, buying below 10 pips, but covering maybe at 30, whatever it is. How many goes can I get around this before we finally break out one direction or another? So something, a different way of thinking about it. Let me know your thoughts and comments, guys, about that kind of strategy. Something that you have to have the right market conditions for, obviously. A little bit more useful in a day trading environment. Although saying that, if you look at some of the daily charts, like on crude and gold and what have you, we often hit key levels and oscillate around them. So I'm sure you could extrapolate that out. But I'm just looking at it purely from a day trading perspective. Anyway, guys, don't forget to subscribe if you haven't already for more videos from me and other traders on this channel. Look forward to seeing you in the next one. Take care. Bye-bye.